Welcome, friends, to the position size module. This is Big T, your host on this journey as you learn how to trade here with ETF Master Trader. All right, why is position sizing important? Let's talk about that a little bit. But before we do that, let's show you where you will find this position size calculator. It's right here on the ETF Master Trader site. You go to Tools and then simply click on Position Size Calculator, and it will take you right here. Now, there are two components to successfully navigating the financial markets. One, you need to have an approach or a methodology that's going to give you an edge in the marketplace above just throwing darts at a dartboard. Now, the techniques that I teach you in ETF Master Trader, specifically the different bullish percent readings and how they relate to buy signals and sell signals in specific sectors, provide you with that edge. They provide you with a statistical, measurable edge that you can use to make money in the stock market, in this case using ETFs and individual stocks based upon sector readings. Now, here's the key. No matter how great an edge you have, if you don't apply money management principles, and the essence of money management principles is position sizing, appropriate position sizing with stop losses, it doesn't matter how good your edge is, you will ultimately lose money because you'll bet too big or you'll take too much risk by not having stop losses. You can have a 90% win rate, but if the 10% of the stocks that don't work out go down 50, 60, 70%, and you've got no ability to place a stop loss on it, then you're going to lose money. It doesn't matter how good the system is, unless you have the ability to place stop losses and size your position appropriately, you will lose money no matter how large an edge you have in the marketplace. This is a critical and crucial step that professional money managers understand, but for the most part, this has not been appropriately explained to the average everyday investor such as yourself. So let's talk about this. Typically, most money managers will not risk between more than 1 to 2% of their entire capital on one trade. Throughout the coursework, the number I've thrown out a lot is 3%. Now, when you're just getting started, when you're really getting a feel for this, I always recommend starting small because you can always ratchet up. So let's say if you have an account value of $100,000, you'd simply put in 100,000 in here, and I'm walking you through now how you would actually position size. Let's say your round trip broker fee. Round trip simply means the commission you'll pay to get in and the commission you'll pay to get out. Let's put that as 20 bucks. And let's say your maximum allowable risk. Okay, how much are we willing to risk of our entire portfolio value on any one trade? Let's be conservative. Let's say 2% is for institutions, that's kind of a wild cowboy number. They'll normally, put anywhere from 0.25% to 1%. But for individuals, 2% is a relatively conservative number. Obviously, if you have a bigger portfolio, 1% is even more conservative. But for a $100,000 account, 2% is a pretty good number. So here we are at the position size calculator. We've typed in what our account value is, what our brokerage fee is, how much we're willing to risk, and then we have to put in the share price. So let's say the shares we're looking at buying are trading at 45. Now, the other part of this is we've got to figure out what our stop loss point is, and there'll be other videos throughout the course that will help you determine where your stop loss point is by looking at the chart. Now let's assume that we've looked at the chart and we've identified that should the stock trade down to 41, that would be a break of meaningful support, and so our stop loss in points would be 4 points. It's the current price of the stock, 45, minus our stop loss point, which we're using an example of 41 as a stop loss point, would mean that our stop loss would be 4 points. That's the amount we're willing to risk on the trade. Now, in order to figure out how many shares we can buy, we simply click calculate, and this will tell us that we can buy 499 shares at $45 with a $4 stop loss. If we get stopped out, we're only going to lose 2%, and it gives us our exact cost of the trade right here. Now, as you can see, we're risking only 2% of our total portfolio value, but the size of the trade represents 22.5% of our entire portfolio value, $22,500. And this is where a lot of people get confused. They say, T, how can I make money only risking 2% of my portfolio value? Because they think, oh, I'm only going to buy $2,000 worth of stock. Well, no, that's not the case, because very few stocks go from 45 to 0 overnight. So what we are looking at, and the way we are determining our position size, is based upon the maximum amount of money we're prepared to lose based upon the stop loss that we've already figured out. So again, in this example, the share price is at 45. We figured out our stop losses at 41, so 45 minus 41 is 4. We were allowing it to go down 4 points before we sell it, before we get stopped out. Our maximum allowable risk is 2%. Our account value is $100,000. There's our broker fee, and here we can see we can buy 499 shares. Obviously, we'd round it up to 500 shares. So there, right off the bat, you can immediately come here when you're questioning, how much should I put into this trade? You can immediately come here and determine exactly how much money you should be putting into the trade. Remember, what you've got to do first is figure out where your stop loss point is, what percentage of your total portfolio you're willing to risk. Simply plug in the numbers and you'll know exactly how many shares you can buy. Again, how does this help us with the edge that we have with ETF Master Trader? Well, what it means is that no one single trade can bankrupt us. No one single trade can put us out of business, because there are going to be times where we're going to have trades that are just not going to work. I mean, we went through a period like that recently where you just had, false alert, false alert, false alert, false alert. I mean, it just happens. It's the nature of the market. And if you're not position sizing appropriately, then you're going to get hurt. If you go in there with your gut instinct and say, oh no, this is the one, I'm going to put 50% of my portfolio at risk on this one trade, what if it doesn't work? You're dead in the water. And I want to impress upon you that big money guys that trade big money don't invest like that. They don't invest as if they're going to Vegas. They have a methodology that gives them an edge in the stock market. They then use position sizing and stop losses, what we call money management methodologies, in order to grind that edge against the market. And by applying appropriate money management philosophies, which I'm sharing with you right now, you will grind a statistical edge against the market that will give you the ability to create a large amount of personal wealth. Period. End of discussion. All right, well, I hope you've enjoyed this brief presentation on how to use the position size calculator. I'll be doing some more videos specifically talking about stop losses, and we'll go through some different examples of applying different stop losses to your position size calculator as we move forward through the course. All right, keep on going. I believe in you. Take the time, learn the material, apply it, Be smart. Remember, in the beginning, trade small. Get your feet wet. Even if you want a paper trade, do that. There are a lot of free sites that you can use that will allow you to paper trade until you really get comfortable with this material. Remember, the market isn't going anywhere. There's going to be a limitless opportunity for you to make money today, tomorrow, next year, 10 years from now. So take the time, make sure you're prepared, and you will reap the benefit. All right, this is Big T. I'll catch you on the flip side, and always remember, let the game come to you.